Great. Well, we're a couple of minutes past 10, so let's kick off in the interest of time. Thank you, everyone, for joining this morning. I'm delighted to welcome Simon Wells to this session to host our spring economic update. Some of you may have met Simon before. He's previously run similar sessions at our growth forum in previous years. And we're delighted that Simon will be supporting us with economic updates as part of the community programme throughout this year, which is fantastic. So there will be two further sessions following this spring one. The format of today is Simon is going to deliver the update, and then we will have about 15 minutes or so for a Q&A. There's two ways that you can ask questions. If you'd like to pop them in the chat as Simon is speaking, then I will make sure those get answered at the end of the session. Equally, everyone is able to turn their cameras on and speak as we have a meeting format today. So please do feel free to interact at the end and ask questions directly yourself. So I'm delighted to hand over to Simon, and we'll let you take it from here.
Thank you very much, Sophie. Morning, everyone. Thank you for joining, and thank you for the invite to come back. Yeah, I mean, as Sophie said, I'll just, as usual on these sorts of things, make kind of 30 minutes of opening remarks, if you can stick with me for that long, and then we can have a hopefully a good discussion. And I'll start by saying a little bit about the global backdrop, and then move into the UK outlook. And then I'll finish maybe saying a few things on UK fiscal policy, not least because on Monday, the Chancellor will unveil the latest spending reviews. Well, what can I say? It's been a fun year. The way I often think about the global economy at the moment is it's 136 days since the 20th of January. So that's about 1,325 to go before we might get a bit more stability in US trade and foreign policy. And of course, tariffs and now the US debt and fiscal situation have been an enormous part of the year, but it wasn't always like that. I mean, we started the year with Europe and the UK being the kind of plodding growth nations of the world. And if we look at where things were from the back end of 2019, an economy such as India, which I don't put on this chart because it makes everything else hard to see, has grown over 40%. The US and the world done well, and Europe's very much to the left of this, with the largest economies, France, the UK, Germany, sort of even to the left of the European average. So we were coming into this year with activity in Europe, and then something happened when Trump came in and started questioning the transatlantic alliance that prevailed since the end of World War II, and showing that Europe and the UK could no longer really rely on the US defense umbrella. There was perversely this kind of moment of optimism in Europe, where we'll take control of our own defense, we'll have more economic autonomy, and within that came a decidedly un-European, or certainly un-German, loosening of fiscal policy. And given the additional uncertainty that was coming into the US, you can see that in stark reversal to what's happened for much of the past 5 or 10 years, European asset prices massively outperformed. So far from a kind of MAGA moment, for much of February, March, we were talking, and I will go on to say that much of the talk was overblown. We were talking about a mega moment and a mindset shift in Europe. And you can see that borrowing costs in Europe rose a little bit on the back of potentially more fiscal stimulus in Europe. But a lot of clients, what a lot of people wanted to know was, where's this money going to end up? You know, how's it going to affect the economy? And there wasn't, at least until April the 2nd, that much chat about tariffs. And then came April 2nd, which I refuse to call Liberation Day, where you had the bizarre sight of Donald Trump going down a sort of 1970s game show style board telling countries what they won. That in itself, the tariffs in themselves were were more punitive than a lot of people were expecting. But it was the manner in which the policy was both announced and devised, seemingly from ChatGPT rather than any economic theory, that perhaps most alarmed markets at that time. Now, since then, we've learned a few things. We've learned that Mr. Trump likes projecting power. He likes causing a bit of chaos in doing so. But when we get up to the brink, whether it's a spiral in US long-term borrowing costs or tariffs, he does tend to bring us back from the brink. And eventually someone whispers in his ear, and you see that the Chinese tariffs topped out at nearly 150%, or 147.6 to be precise. The US tariff on China was briefly 126.5%. Very quickly, the consumer electronics were removed from that. And now we've sort of settled at about 50%, which is a number that was bandied around during the election campaign. And on the rest of the world, we are sort of looking at the baseline tariff of 10%, at least until the 9th of, or probably until the 9th of July, when that 90-day delay expires. Now, of course, this is still a big rise in tariffs. It's a big rise in tariffs from Chinese imports. It's also a big rise in the US tariffs from the rest of the world. And this could have kind of non-linear effects on confidence. Obviously, the last time we had tariff rises of this magnitude, that was wrapped up within the Great Depression. So there could be, economists like me, we tend to just run through equations. Well, how much is imported, how much prices rise and be passed through to consumers, and that kind of thing. But that type of modeling isn't well suited to if there's any kind of, as I say, major step changes in mindset or confidence. So there are still risks there, but so far you'd have to say much of the economic data incoming, while not great, has not been catastrophic either. So what's the underlying agenda here? Well, it's not always obvious that there is one. The US itself has a policy of tariffs, of deregulation, of tax cutting, and what we might call abundant energy. And it argues that all four of those are four prongs of the same MAGA agenda. I mean, in terms of tariffs themselves, I think there are roughly four specific elements to it. The migration and the fentanyl. There is some revenue raising element to it. Probably the biggest thing that comes across and always has is it's basically China bashing. And then there are some economic objectives, reindustrializing the US and closing its goods trade deficit with the rest of the world. And incidentally, if you want to close the goods trade deficit in a hurry, you never export your way out of that. People always say, oh, we're going to export our way out of the deficit. That never happens. The only way they close is through a massive recession that reduces import demand or a sudden stop in the capital inflow that pays for it. So if we really are going to close the US trade deficit quickly, then we probably are looking at a monumental US recession. But at the moment, given this playbook of taking us to the brink, bringing us back, every time we relax, chucking a new grenade in, but then bringing us back from the brink, I think we'll probably see a fairly chunky US slowdown, but hopefully we avoid a major recession. Now, in terms of those economic aims, well, it's certainly true that the share of US employment and the share of output in manufacturing has fallen a lot since the early 1980s, partly due, of course, or largely due to globalization and the acceleration that you see when China joined the WTO in 2001. So yes, whether or not you think that manufacturing is somehow more virtuous than services, I don't want to get into, but that's a fair aim, and you can see why that is on the agenda. On the other hand, in terms of boosting domestic investment, Biden already did that through the CHIPS Act, through the Inflation Reduction Act. You can see the massive rise in manufacturing construction and manufacturing investment through the Biden years on the right-hand side. Indeed, it's the repealing of those acts and the incredible uncertainty that's been caused, you might say, that has caused the turning point and actually had the opposite effect of what Mr. Trump wants in terms of domestic investment. But anyway, that's an aside. And then on the trade deficits, looping together what I said about closing it quickly and the ChatGPT formula that determined the reciprocal tariffs. Here's something that is, just shows the economic illiteracy around, in my opinion, around some of the policies. The EU got slapped with a reciprocal tariff of 10% initially because it has a goods trade surplus of around 1.5% of GDP with the United States. So it exports more than it imports in goods space. But it has a deficit in services. That's the grey line on the left, and they roughly balance out to an overall balanced current account position with the United States. But because the focus is on goods, they get slapped with the tariff. The UK, by contrast, got away without any reciprocal tariffs and are now, of course, signed a limited trade deal with the US to hopefully cement that as much as anything can be cemented, because its goods trade position is roughly in balance. On the other hand, it runs a huge surplus position. So its overall current account is actually in surplus with the US, but because, as I say, services so far weren't really considered, the UK got away with the 10% baseline. Incidentally, of course, if the US trade deficit were to narrow, either through a big recession or even through the miracle of exports, that of course means a less of a capital inflow, and that in turn means who's going to buy a huge chunk of the massive US public deficit, which of course is very much in focus at the moment with the big beautiful bill. That's probably all I want to say about tariffs. I'm very happy to ask any questions, but the major economic implications and lessons can be drawn out. The first is it's the uncertainty that kills us a lot. Okay, I'm interested in your views, but a lot of businesses seem to say, this is not a great climate to be investing or hiring. People are waiting for a bit more clarity. Now, you can't sit on your hands forever, but it does certainly seem from the second quarter, we're going to have some very wild GDP data. And after the initial front loading of exports into the US, we'll get a hangover from that. But uncertainty is really not knowing where you're going to be from one day to the next. Because if you just said, right, we're having 10% tariffs on the rest of the world, 50 on China, now we're done, markets could adjust, businesses could adjust, but that's obviously not the playbook, and it's all about who's got the cards and the leverage for bilateral negotiation. So that's kind of one lesson we can tease out in terms of the economic implications. The second is that what we've seen is weaker dollar and a big fall in energy, in oil and gas prices. Now, for the UK and for Europe, that of course is a windfall. So that brings down inflation and is good news in a sense for consumers. Perhaps before April 2nd, when we were discussing tariffs, we might have said, well, the impact also depends on the degree of retaliation. Now, what we've learned from perhaps always expected, but what we certainly see now from a European perspective is retaliation just isn't really going to happen. In the EU, there's no way they can find the political unity to retaliate in a sizable way. The EU couldn't even retaliate on steel and aluminium tariffs, so just those two small factors themselves, without the French demanding a last-minute carve-out of Bourbon, fearing reprisals on its own drinks industry. And Meloni in Italy said she was going to lead a blocking minority, and it's just going to be difficult. The UK, just too small, too open, better just to sort of suck it up and try and do the deal, which of course it did. So the UK looks like it's stuck with the baseline, but at least it's got the deal. But the important point there, I think, is without sizable retaliation, the rise in import costs that might otherwise have been seen does at this moment look unlikely. So Elsewhere outside the US, this is very much, I think, or certainly in Europe and the UK, this is a disinflationary impulse. And that disinflationary impulse is reinforced perhaps maybe by a bit of trade diversion from China and other places with cargoes that were destined to the US. Maybe some of that is now landing in Europe and the UK at lower prices, providing a sort of another short-term disinflationary impulse. So I think those are some of the things we've learned about this. And then the other thing, I'll say a little bit more about this when we talk about fiscal policy at the end, is we have learned that Europe, even though there are practical limits to what can be done, both in terms of what markets will lend countries, what can be built in the short term, and how quickly defense expenditure can be ramped up, we've learned that there has been a bit of a mindset change in European fiscal policy in particular. There is, in Germany, it seems a little bit more willingness to borrow than there had been. And that is symbolic and important, even if some of the numbers you may have read about in the press are probably grossly overstated in terms of what will actually hit the ground. But let's talk now, shift briefly to the UK. The left-hand panel shows the main measures of GDP, and then a measure that strips out the public sector and or looks at GDP per capita, and you see a picture of broad stagnation. I mean, GDP per capita is an interesting concept. We don't really can't particularly well measure the number of people in the country or GDP, but anyway, for what they're worth, those are the numbers. But the pattern in the UK economy that's shown on the right has really been one of stop-start. First half of last year was quite good. Those red bars show monthly GDP growth, and we had some decent prints first half of last year. Then Labour come in, and far from 97 style things can only get better. Rachel Reeves tells us how awful things are going to be, and consumer confidence in August absolutely plummets, and the economy related to that grinds to a halt. And then in October we have the budget, and having said she wouldn't play fast and loose with the finances, it's a very expansionary budget, and it adds an employer NICS contribution, which causes business confidence, shown here on the right, really to plummet in October after the budget. And many businesses feel they were, or said at the time, they felt a little bit misled on that. So that then was another stop. But actually this year, going back to this chart, you can see February, March, pretty good numbers. Overall GDP in the first quarter grew by 0.7 in the UK. That's a pretty good number by recent standards. So actually, until April 2nd come along with all the additional uncertainty that brought, the UK economy wasn't doing too bad. And then the left-hand panel here is the most widely watched survey of business activity, and anything above 50 points to a fall in activity relative to the previous month. So you can see after a little fillip at the beginning of the year, we've settled it to sort of just around 50 in the overall economy, so pointing to broad stagnation. But again, given the shocks, the upheaval, everything that's happened in the world economy, actually, you know, you could say things might have been a lot worse. And I'd say one of the reasons that the economy is holding up is because on the domestic side, inflation's coming down, wage growth is still pretty high, as I'm going to go on to say, employment's still relatively high, if rising. And so you can see on the right-hand side, the black line, the rise in real household disposable income. It's pretty good. Now, spending that hasn't been quite so strong, as you can see by the red line and that gap that's opened up. Of course, the corollary of that is shown on the left, is that at the moment, the UK savings rate is very high by historical standards. The question is, you know, is confidence going to be there for people to start to spend, or are they going to be worried about their jobs, worried about the geopolitical situation or whatever? But yeah, that savings rate surely can't continue to rise at the pace it's done. So even if it stabilizes, the real income growth that we're seeing does provide, to some degree, some backstop for the UK economy, and it's a similar position in Europe as well. So that's another piece of relatively good news. I'm a macroeconomist, a depressing person, as you know, but this is some a decent consumer backdrop in many ways. That being said, and related to what I said about the uncertainty and the degree of cost rises as well, demand for staff has come down, and employment intentions, they've not fallen off a cliff, but they have ground down over the past 6 months or so. You would expect that, perhaps, given the international backdrop, the interest rate situation, and the general demand situation. I've not bothered showing you the official unemployment numbers. The unemployment rate is at 4.5% at the moment. That's the highest it's been since the summer of 2021. But even now, the Statistics Office don't really have much confidence in the UK employment data. So we have to use other things. And they've said that they will have it sorted by November 2026 at the earliest. So we've still got quite a long wait before we have accurate and reliable employment data in the UK, which of course doesn't make the Bank of England's job any easier. That being said, I think that the UK labour market is still relatively tight. I love a good Beveridge curve, which plots the vacancy rates in the economy on the y-axis and the unemployment rate, that unreliable unemployment rate, on the x-axis. And you can see the UK, after the pandemic, moved to a really unusually top left spot in that. Vacancies were very high, unemployment was very low. We've moved almost vertically down, but we're now in a much more normal position for the UK labour market. So some of that tightness has gone, but it's still fair to say that pay growth is still pretty high. The main measures of pay growth still a touch under 6% in annual terms. You can see from the PAYE data, the red line on the left, that actually spiked up a bit in April. Again, that was related, I'm sure, to the minimum wage rise. The point is, if you've got 6% pay growth and the UK doesn't have much productivity growth, your costs are rising a lot, particularly for a service sector firm where labour is a huge portion of your costs. You can see on the right, therefore, the overall unit labour cost, what it's costing a firm in labour terms to produce a unit of output, actually re-accelerated in the first quarter, and it's still way too high to be consistent with the 2% inflation target, because if your costs are rising at 6%, you've got no productivity growth to speak of. You've got to be passing that on to your end consumers, and that is a worry for the Bank of England. I've already mentioned that the oil price has been a bit of a windfall, energy, currency as well, although if you just look at sterling dollar, you probably get the wrong idea of just how much sterling is appreciated given the euro position. The overall trade weighted sterling, that red line in the middle, is up kind of 1.5% since over the past couple of months or so, but it's not quite as big as, say, the appreciation that the euro has seen. But that's all, as I say, favourable for inflation. You can see we've reduced our inflation forecast to a little bit, and it still falls back to 2%, or just over 2%, as some of these one-off rises start to wash out. Now, I said that the unit labour cost position will worry the Bank of England. It will, but I just wanted to show you, I mean, we had awful April. It was awful because of the NICs rise for firms and the minimum wage rise for firms. And it was awful for consumers because of the utility bill rises, particularly water, but also fuel that you see on the left-hand side. The right-hand side shows us what service sector inflation was in the month of April relative to an average April. And you can see it was way bigger than anything we've seen recently in terms of being above average. A lot of it was water. Some of it was airfares, and because of the different timing of Easter, there was a seasonal pattern in airfares that will drop out in next month's print, presumably. But there's still quite a lot of core service inflation in there, related, I think, to that unit labour cost point that the Bank of England is worried about. And so it's for that reason, I think they're going to be relatively cautious with their interest rate cuts. And the market thinks they're going to be even more cautious. So you can see market prices currently pricing the Bank of England stopping at somewhere between 3.5% and 3.75%. That seems a little high. I think the market's got a bit of a risk premium in it. I expect rates to come down gradually, maybe to something closer than 3%. But these concerns about services inflation will keep the Bank of England, I think, cautious. So probably looking at a 1/4 point cut every 3 months or so would be my baseline. As I say, obviously, financial markets expecting a little less than that. And then in Europe, the ECB, they're hopefully going to cut in a few hours' time, and that may be it for them, with rates bottoming out at, well, 2%, maybe one more cut in September to 175. But big picture, I think that it's largely done. Now, I do want to leave a good chunk of time for a discussion. But at the same time, I do want to talk a little bit about the spending review in the UK fiscal situation. Given the geopolitical shocks, the trade shocks that have hit the global economy this year, yeah, it's not great. But as I say, a lot of the incoming data has been a little bit better than we might have expected, a degree of resilience. So hopefully I've given you a little bit of positivity. I'll be honest with you, on the fiscal side, I don't really have a whole lot of positivity, but given I've got a captive audience here, I'd like to just spell out some of these fiscal challenges. So on Monday, we'll get the 3-year spending review. This allocates an overall envelope of day-to-day public sector spending, so-called RDEL, for obscure reasons, and how that's already, the overall limit is set. This is about how it's divvied up across departments. And the overall limit's shown on the left. So quite a bit of growth in spending this year, but then it slows markedly. And the overall real terms public spending our departmental day-to-day spending grows about 1.2% a year on average after this year. Now, the problem is, if you're going to grow overall spending at 1.2, if you have kind of historical levels of NHS spending, plus your defence promises, you've got to find cuts everywhere else, basically. So core schools likely to see cuts, and every other department, cuts of about 0.7–0.8% a year. Is that feasible? I don't know. I tend to call these things fiscal fictions, but that's what they will tell the OBR, the fiscal watchdog, what they're going to do. But the point is, given the NHS and the defence promises, it's other departments, despite the overall rise, are still going to be under huge pressure. And so Monday's spending review is really going to shine a light once again on some of these challenges. Now, at this point, what I want to do, the slides get a bit more bells and whistles now, because I gave a big presentation on big state presentation on fiscal policy a few weeks back, and I'm just using the slides. Now, already, the point here is that even just for the latest fiscal year that only ended at the end of March, the latest data already show that borrowing last year, now we've collected a bit more data, was worse than the OBR were forecasting in March. Now, that's bad news in the near term, but the longer term news is worse. This is UK public sector debt as a percentage of GDP. And you can see before the financial crisis, it was typically 30–40%, and then it ratcheted up to kind of 60–70%. And then in COVID, it ratcheted up again. So despite all George Osborne's austerity, debt as a proportion of the size of the economy never actually fell. And now, thanks to Rachel Reeves's promises, it pretty much flatlines for the next 5 years. Doesn't actually go down. But then, if we look, because of the aging population and healthcare commitments and welfare commitments, it spirals off into the stratosphere from the mid-2040s. And this is alarming. It's a direct result of, as I say, policies, pensions, and the aging population. And it's not new. In fact, when the OBR was started in 2011, it produced this long-term debt trajectory. And I remember when it produced it, we were all saying, oh my God, by 2060, we were going to have debt over 100% of GDP. That's surely not possible. Well, we're already there. And of course, now the starting point is much, much worse than where we were. Of course, against that starting point, we had a very highly expansionary budget from Rachel Reeves in October. As you can see here, this shows the overall change in borrowing from that budget, pretty high. That was maintained in the March spring statement, and she basically has 10 billion of headroom. Now, at least a third of that headroom has probably already been wiped out by the rise in borrowing costs since March. And so the public finances are constantly at the mercy of markets, one, particularly since the trust quartering mini budget, and fairly arbitrary assumptions from the wonks at the OBR, people like me. And we should not be making big welfare or tax and spend decisions twice a year just on the basis of forecasts for people like me, I would argue. I would prefer we had one fiscal event a year like most countries. But anyway, I can sort of explain in more detail why I think that. And because even these woeful projections we've got are based on very high forecasts for growth. Even now, the OBR is a little bit higher than where we're expecting growth to be. Maybe both those, in light of the latest, there are upside risks to both of those in light of the latest data, I suppose I should point out. But the point is, the OBR is often quite optimistic, contrary to what you might read in the press. And one of the reasons it's optimistic is it's always pretty optimistic about productivity. It sees productivity growth returning above 1% and staying there, something that hasn't happened really since the financial crisis. And in fact, if you look at its past forecast, it always sees that, regardless of reality. And in fact, if we go back before 2016, it was expecting a return to pre-crisis productivity levels, and clearly we haven't seen anything like that. So we really, that the public finances are just so much at the mercy of the market, and kind of if there were to be a judgment changed by the OBR to revise down medium-term productivity again, it would be very, very damaging to the projections. So there's got to be a combination of tax rises, spending cuts, or getting the economy growing. I think that's that's stating the obvious. If it's going to be tax rises, what are the most likely candidates? Well, 3/4 of tax revenues come from the big four taxes: NICS, income tax, corporation tax, and VAT. Doesn't seem like she's going to raise VAT in the current economic climate. She's promised she won't raise corporation tax, and of course, she's made the rather boxing in promise not to raise taxes on working people, whatever that means, and you can decide for yourself whether the employer NICS rise was a tax on working people. But anyway, so if you're not going to touch those, you're not going to raise much tax revenue. I think that's the point. And so at some stage, the basic rate of income tax hasn't been raised since Dennis Healy. At some point, we might need to revisit that. And that's part of the reason for that is, of course, it's always very fun to say, well, let's just tax the rich. Fine. But quite often when I go around the country talking to people, they say, right, they're lining up to tell me about their friends who've left the country for tax reasons. 3% of people pay the additional rate of tax, and they pay over 40% of the total income tax burden. So it is a real issue. And, I think there's possibly, a case for sort of breaking the taboo of touching the basic rate of tax. But anyway, I'll just dangle that one with you. And then on the spending side, just very quickly, it's all about the welfare and the health budget. Those are the things that have grown recently. Those are the things that, given current promises, send that trajectory up into the stratosphere. And actually, really, there's not been much real terms cuts at all, but where they have come, curiously, is in defence and housing. And so, you can't get control of the spending unless you can get control of the health and welfare budgets. This is a nice chart of mine that brings together, a nice chart of mine, a chart that I like, which shows that the first time health spending in the UK exceeded defence spending was at the end of the Cold War in 1989-90. And since then, of course, as I say, health spending has ratcheted up to over 8% of GDP, while defence spending has settled at 2%. Well, we now know that's going to be 3.5%, maybe more over the longer term. The point is, if you want to return to Cold War levels of defence spending, you've probably got to return to something closer to Cold War levels of health and welfare spending as well. And that, of course, is going to be politically very, very different. And a final thought is just how much the UK is now spending, like other economies, on its debt interest. As I say, this is probably even higher given moves since these projections by the OBR were made in March. But we're spending between 3.5% and 4% of GDP on debt interest. That is more than the entire schools budget. So it matters. And then, of course, we've got to go for growth. We need to invest. Rachel Reeves has upped the amount of public investment, but only really to keep it constant as a percentage of GDP rather than the falls that were planned under Jeremy Hunt. And the other thing we need to do is, so the question is, where should we invest? One area is clearly in energy. Maybe Europe is well known to have higher energy costs than its major competitors, which hampers it. And of course, if I add the UK on, we're even higher than the rest of Europe is. So this is clearly one area where we could get the economy growing. And the other is housing. The government target translates into something like 375,000 houses built a year through the Parliament. Nothing like that has been achieved since the 60s, 70s. But even if we got halfway there, it would be a benefit. And if you build houses and infrastructure where people live and where people want to live, it may do something to reduce the massive regional inequality that the UK has. And that might be helpful too. Thank you for indulging me on a little fiscal deep dive. I think it is topical given what's going to happen on Monday. But let me sort of stop there and say there is an enormous amount of uncertainty still. I mean, people can't sit on their hands forever. So far, the damage on the economic data from tariffs and everything that's going on doesn't seem to have been as bad as it might have been. And there's a decent amount of real income growth that people are receiving in the UK at the moment. But of course, there are still huge risks, and we need to be mindful of that. But I suppose the most optimistic thing I can say at this point is things could have been worse.
Brilliant. Thanks, Simon. That was really informative and interesting update. So we've got just about 20 minutes. If anyone has any questions at all, just having a look in the chat, we haven't had any during this session. But this really is your time to ask Simon anything on what we've just covered. So please do pop your cameras on and ask any questions. Well, it looks like we have that was a very well-rounded session that hasn't prompted any follow-ups. Everything was covered very thoroughly. If anyone does come up with any questions between now and sort of going forward for the rest of the day, please do drop me a note. I can pass these on to Simon and we can get questions answered. It's also worth noting that I will pop the recording of this session onto Scale for anyone that would like to watch any of it again or would like to share with anyone within your team. Also, I will be able to pop these slides up as well, just to be viewed on scale. Thank you, Simon, for running the session. It was fantastic and really insightful, and we look forward to another update in, I think it's September time.
Great. Thank you very much. Enjoy the rest of your day.
Brilliant. Thanks, everyone.